So you might be wondering, why do I keep getting all this mail, email, phone calls regarding ERC, better known as the Employer Retention Tax Credit? What the heck is this and how does it relate to me? Hi, my name is Mia Taylor. I'm a tax advisor and owner of Heiko Tax Consulting Co. Now, make sure you stay until the end of this video because in this video, I'm going to teach you how to fully assess whether or not you are eligible for the Employer Retention Tax Credit. So without further ado, let's get started. But before we go, don't forget to hit the notification bell, like, share, and subscribe to our channel for more tax tips like this. So, what exactly is the Employer Retention Tax Credit? The Employer Retention Tax Credit, better known as ERC, is a refundable tax credit for employers who kept their employees on payroll during the national COVID-19 pandemic. Now, the Employer Retention Tax Credit was created through the Coronavirus Aid, Relief, and Economic Securities Act of 2020, better known as CARES Act. Okay, that was later extended under the Coronavirus Response and Consolidation Appropriations Act of 2021. Now, if you qualify, this credit could be a game changer for your business. So Mia, what are the details of ERC? How does it work? And if I qualify, how can I claim it? Okay, well, let's start with the first question. How does the Employer Retention Credit work? The Employer Retention Credit is a refundable tax credit directly reducing your business federal payroll tax liability. So in other words, this means you could be eligible to receive a dollar-for-dollar refund on payroll taxes and wages filed during those qualifying periods. Now you might be thinking, this is way too good to be true, and you're not completely wrong. See, to be eligible for ERC, your company must meet specific criteria. There are 3 ways you can qualify for the Employer Retention Credit. You must qualify for at least one of the 3 to meet this criteria. So qualifier number 1 is your company must have had a significant business loss during 2020 or 2021 compared to the tax year of 2019. And here's the trick. Each year is compared by quarters. So what is a significant business loss according to the Employer Retention Credit rules? A significant business loss for purposes of ERC is to report gross receipts in qualifying comparable quarters at losses between 50% and to as little as 20%. Therefore, to express a significant business loss for qualifying periods in 2020, your business must have had a 50% or greater loss in gross revenue for comparable quarters in 2019. To report a significant business loss for qualifying periods in 2021, you must have reported a 20% greater loss in gross revenues for comparable quarters in 2019. Well, what if my business did not start until after the tax year of 2019? Can I still become an eligible employer to take the Employer Retention Credit? Absolutely. The rules are the same. The only difference is that you will compare each respective quarter in 2021 to the same quarters in 2020, assuming that you started your business in 2020. Caution. The moment your business gross receipts in comparable eligible quarters are less than 20% in losses, you are no longer qualified for the Employer Retention Tax Credit. Now, qualifier number 2. Your company must have received a full or partial suspension of business operations due to governmental orders related to COVID-19. Now, this simply means that you must have been notified by your state or local government agency to shut down operations. Voluntarily shutting down your business operations for safety precaution does not qualify as a government mandate shutdown. Qualifier number 3. Your company must have experienced a disruption in its supply chain, meaning your business had a significant impact negatively because you could not get critical products delivered in time to service your customers, which caused you to temporarily close your business until products were received. Now, here's the catch. To legitimately say you had a disruption in your supply chain, your supplier would have to prove that they received governmental orders to shut down. If your supplier has proof of shutting down because of governmental orders, but you as the business owner have a surplus of supplies that did not disrupt your business, you will not be able to use this qualifier to qualify for the Employer Retention Credit. So what if I qualify to take the Employer Retention Tax Credit based on one of the 3 qualifiers briefly described in this video? Well, if you reach this point in the process of qualifying, now you have a whole nother herd of rules that you've got to jump through just to get to this lucrative tax credit, right? So there's 3 rules that I need you to be aware of. And rule number 1 is you must be an eligible employer. That's right. There's 2 types. There's a small employer, then there is the large employer, and they are both uniquely defined. Now, For the purposes of this video, we're only going to discuss within the scope the small business employer, okay? So the small business employer is an eligible employer if you have an average of 100 or fewer employees during 2019 or an alternative qualifying year, 2020. Now, the eligible employer is deemed to have an operating trade or business that is in pursuit of a profit. Okay, that's very important. If you did not have a business in 2019, all is not lost. This rule applies to the year in which your trade or business was active with employees in 2020 and 2021. Okay, now rule number 2 is you must have qualifying wages paid to rule number 3, qualifying employees. So let's start with rule number 2, qualifying wages. Qualifying wages for the purpose of the employer retention tax credit is wages paid to employees, which include pre-tax employment benefits such as 401k, health insurance programs, SHA, you name it. But if you have independent contractors or you're paying people where you don't have to withhold taxes, right, like your children, their wages will not be qualified. Now, if you received a PPP loan to help cover the cost of payroll, the portion that covered payroll will not be qualified as wages if the PPP loan was forgiven. Okay. Now, rule number 3 is you must have eligible employees. Now, as a small business employer, your employee does not have to be full-time for the wages to qualify for the credit calculation. However, not all employees are eligible. Some of us are using the pay yourself and family tax strategy. And so a lot of those folks are not going to be so lucky. The wages and the status just do not qualify. What do you mean? That means you, your spouse, your children, your grandchildren, your parents, your grandparents, your stepmother, your stepfather, your nieces, your nephew, uncles, aunts, brothers and sisters, and all in-laws who are paid as employees in your business do not qualify as qualified wages or employees for the purposes of the retention tax credit. Now, let's say not all is lost and that you actually meet all the qualifiers, right? How much of a refund would you actually get? Here's how the calculation of the refund works. So if you have qualifying wages paid to eligible employees during the period of March 13th of 2020 through December 31st of 2020, then you can receive a credit amount equal to 50% of wages paid up to a max of $10,000 per employee for all qualifying periods within that little time frame, right? So, for example, if I paid 10 eligible employees during the qualifying period, which equates to a max credit of $5,000, this is going to give me a cash refund of $50,000. Does that make sense? But what if I qualify in quarters during 2021? That's different. Now, if I have qualifying wages paid to eligible employees during the periods of January 1st of 21 through June 30th of 21, then I can receive a credit amount equal to 70% of wages paid up to a max of $10,000 per employee. Now, my maximum credit is going to be $7,000 per employee per qualifying quarter. Now, for example, if I paid 10 employees during the qualifying period and I qualify for just one quarter of the 3, then my cash refund is going to be $70,000. Now, let's say I qualify for all 3 quarters, right? Then my total cash refund is projected to be $210,000. But taxpayer, be aware, as a tax advisor, it is my duty to share with you the risk of taking this credit because of the complex rules that govern the qualification that we spent a bulk of our time during this video. Now, if you take this credit, you are required to amend your payroll tax returns and your business income tax return. This will impact your tax position. As a result of taking the credit, you are required to remove the payroll wages and taxes paid as a business deduction on your business tax return in order to properly apply for the credit and request a refund. This is where you want to assess whether or not it makes sense to take the credit if removing the tax deduction on your business return will increase your tax position to a point where you may owe the IRS. Essentially, it's like you're getting a refund from your payroll taxes to only pay it back to your income taxes if your business had better performing quarters that did not qualify for the ERC calculation. Now, On October 2022, the IRS issued a notice stating, employers be aware of third-party promoters who improperly make claims that anyone can receive the ERC tax credit. As you can see, qualifying for this credit comes with a complexity of rules just to weed people out. However, if you do qualify for this tax credit, it can help you turn your business around for the time where you had a real negative impact because of COVID-19. I hope this video was helpful. For more videos like this, please like, share, and subscribe. If there's a specific topic that you would like to know about, please post it in the chat section. Let us know and we'll do our best to come up with a video that is addressing your tax question. Thank you, and that is your HICO tax tip for today.